What's unique about the sector, or both those individual sectors, is the fact that they've grown up for a number of years, and often the case is that they've been brought together in terms of the form that they take now, around a sort of amalgamation of various different companies. So when you think of the longevity of some of these huge corporates and how they're being constructed, whether it's through M&A activity as they've looked to expand, etc. So what they're adopting and what the model and the sort of modus operandi that they work to today is very challenging, to say the least, because what they're looking to do is trying to optimize a somewhat suboptimum structure that they have. Now, the challenges that sort of brings is, how do they actually bring that standardization together? Technology is definitely a key factor. So when they look to the ERP systems, many of which have been brought, so have multiple instances and also multiple different ERP systems. And therefore, one of the challenges that they face is, how do I bring that into one single instance? And really saying that, the industry as a whole, because of the experience and because of the longevity, has a number of benefits that it can bring to that. The way in which they have sort of shaped a lot of the other sectors in relation to best-in-class processes, best-in-class management of whether it's liquidity or risk management, and also some of the sort of early adopters across a number of the sort of products and solutions that are now synonymous across all sectors. Take, for example, payment factories. Those in consumer and healthcare tended to be the first adopters of those types of solutions, and therefore what that's now put them in is they can start looking at further efficiencies within that sector that is obviously given them a tremendous amount of advantage. So when I look at the corporates in the consumer and healthcare and how they can improve liquidity and risk management, I think the key thing on both aspects, and this is a theme throughout, is visibility. Looking at their ability to see what's out there in terms of their liquidity, knowing what pockets of liquidity sits there in terms of their structures. As the consumer and healthcare sector as a whole is complex, is vast. There are a number of players out there that have multiple global operations, and therefore you can imagine the number of accounts that they have within these structures. Just trying to get visibility over those accounts, I think, is the key and first step to any organization looking to optimize their liquidity. Now, as regulations change, as markets become more free, what that allows a lot of the corporations to do within the consumer and healthcare sector is to say, take my existing liquidity model and how do I look to refine that? How do I look to expand that? So as markets become a lot more open to the ability to transfer money cross-border or through cross-currency conversion, these structures continue to grow. When I look at the risk management, it falls under the same sort of means, which is knowing what is out there and knowing where I currently have my liquidity, and also once I have that visibility, what am I going to do with that? Visibility is one thing, but then I've got to make a decision on the back of that, and that is all to do with risk management. One of the things that we've been seeing more and more so, and understandably since the crisis of 2008, is in relation to the concerns that clients have with counterparty exposure to banks, and therefore have looked to not only manage that on a much more active basis, and in often the cases looking at the liquidity positions on a daily basis, but also how they view those banks, and taking a lot more insights in terms of CDS spreads, in terms of credit ratings, that really give them a bit more understanding as to the risks that they possibly have in relation to where those deposits sit. And what that's also led to is it's further sort of investment options within relation to that liquidity. So investment into different types of investments, whether it's money market funds to diverse away from bank deposits, also looking at other things such as tri-party repos, looking at investment into commercial paper. So a whole range of solutions that help manage that. Consumer and healthcare corporations have started to look at supply chain finance, and I say started, it seems to be more of they've turned a bit of a corner. It is somewhat of a mixed bag still, but we're definitely seeing a lot more consumer and healthcare names querying these types of solutions. Now, for a number of these clients, they've always had some sort of financing arrangements in place in a number of sort of countries, but it tends to be at almost at a local level. What I think is changing very much so is the organisation as a whole, and therefore you can see this in terms of how the different types of positions that are being hired into in terms of global responsibility for working capital, some of the metrics and the KPIs in terms of alignment across not only Treasury but also functions within the whole finance area. And they're the sort of trends that are obviously showing that these types of solutions are becoming a lot more available, but also a lot more in demand. It's probably wise to sort of separate what is cash flow forecasting, because there's very different degrees. And starting with what has become a lot more successful is on the short term. So usually anything up until the 30-day process. And the reason being is that there is a lot more sort of visibility in relation to what payments are going to be going out the door, what some of those receivables are going to look like, what the liquidity positions look like, and therefore the ability to forecast on a short-term basis has improved dramatically. But one of the challenges, both on the short term and on the longer term, is consistency. Consistency of process. So that is ensuring that the way in which they gather a lot of this information from each of the sort of end business units is consistent. That one is describing a flow in the same way as another country or another region. And that in itself can be a challenge, especially with some of the consumer and healthcare names, in terms of the size and the breadth and the depth of the countries that they go into and where they operate in today. Consistency also in relation to data itself and the quality of data. There's been a number of sort of advancements over the last couple of years in relation to Swift messages in terms of the richness of a lot of that information. A lot of the consumer and healthcare names have really looked to reinvigorate the way in which Treasury manages their cash and has visibility over that. So many have looked to adopt either new TMS systems, Treasury management systems, or have looked at their existing Treasury management systems and see, is that an optimum way. One last point in relation to on the short term is that liquidity itself, in terms of the management of that, in terms of the automation of that, has become a lot more common throughout the consumer and healthcare names. And really what that does is it allows for a lot less reliance upon some of this forecasting, because they should feel comfortable that the end position is going to be deployed or funded in a way that they want to, at least on the short term. A couple of things that have sort of changed in recent years. One is regulation. So we've seen a lot more freeing up in terms of new structures emerging, like payment on behalf, that have allowed for a lot more efficiencies within the in-house bank. Technology has also changed in relation to leveraging new ways in which they can connect with banks, whether it's SwiftNet, whether it's new message formats such as ISO XML, that really provide that consistency that no matter which banks they're dealing with, they're able to provide it in a consistent and standardized format, which is obviously going to drive cost and inefficiency out of the organization.